Hello, I am Adam Grimes, and welcome to Interactive Broker's Introduction to Technical Analysis course. Here in Unit 3, we're going to be talking about moving averages. Brief outline. First of all, we're going to talk about what is a moving average. We're going to look at some different types of moving averages, and then we're going to consider how they're used in traditional technical analysis. So, what is a moving average? Well, you know what an average is. If you want to average things, you add them up and you divide by the number of things you have. That's how you construct an average. All a moving average is you're looking back over a past window of prices and you're moving that window forward. It's also called a rolling or running average. Sometimes you will hear mean used. This is a tool that is not unique to financial technical analysis. It's used in many disciplines. And one reason why is because it does two things very well. It removes noise and highlights underlying trends and data. And you can see both of those things would be pretty good to know in markets, right? They're also used to remove certain cycles, and they pass certain cycles through, which might or might not be important depending on how you trade, but it's something you should probably be aware of, that moving averages are essentially what we call a low-pass filter. In technical analysis, probably what people use more than anything else is considering the relationship of price to a moving average on a chart. I'll show you some examples of that in just a moment. Be aware there are many different types of moving averages. I'm showing you here in Trader Workstation where you can find the moving averages. Most people probably use either a simple moving average or an exponential moving average. But be aware there are many other types of moving averages, different ways to calculate and weight a moving average, and also many tools that are derived from a moving average. We're going to look at some of those later in the course. But if you have never used a moving average, at least you need to know there are many, many different types of moving averages. And they're a little bit different. So you see here on your screen, here are three different 50-period moving averages. The red line is a simple moving average that is calculated in the way I explained with the moving window. And then the other two calculations are weighted a little bit differently. The blue is an exponential, and the green is a weighted moving average. So you can see they're all 50 periods, but they respond a little bit differently to prices. Some are closer to price, some will change more quickly or more slowly in response to the market's turns. And that's a trade-off. If you use moving averages, you need to be familiar with the tool you're using and understand exactly what and how you're calculating. One of the big differences with different types of moving average is the length or period of the moving average. Now on your screen, I'm showing you two simple moving averages of different periods. The red is a 50 period, the blue is a 10 period. And because the blue averages a shorter window of prices, you can see it hugs price much more closely. When price changes, when the direction of price changes rather, then the moving average changes very quickly. Look at this point on the chart where price turns down, and you can see the blue line turns down also, while the longer 50-period moving average seems to not even know that this change has happened in price. So different periods of moving averages will be closer or further away from price and will respond faster or slower. Now, this matters because one of the ways we use moving averages is to consider the slope. And when we say moving averages can filter out noise and highlight trends, well, we can see that when the moving average is sloping up, that the market is going up. The trend of the market is up. And if you look here where the blue line caught very nicely this turn in the market, where the market shifted to a downturn, so if you were following the slope of the moving average there, it would have told you something about the trend of the market. But the question is, which moving average? And you can see that the longer moving average didn't even respond until just over here at the end, it starts to turn down. This is important to understand because depending on how you trade, how long you look to hold trades, how you get in and out of trades, different moving averages might work better or worse for you. So you need to understand how to take the tool and how to make it fit with your trading style and approach. One of the other things that people look at with moving averages is where price touches or crosses the moving average. And if you put a moving average, pretty much any moving average on a chart, you're going to see points where it looks like the moving average provided some kind of support and resistance. You're probably going to see other places where the price crossed back and forth through the moving average. And this is just a consequence of the way the moving average is calculated, but some people do generate trading signals off of this. We're going to talk about statistics and looking at what's actually going on here in just a moment. And then one of the other common ways that moving averages are used is to look at crosses between moving averages. And here we still have our 10 and 50 period moving average. And the basic idea as a start of a system would be that when the short period moving average crosses over the long period, which you can see happened around here, that would be a signal to become bullish or maybe to take a long position on the market. The problem with this, of course, is that there are periods where, and this did catch a trend very nicely, but there are other periods, like at the beginning of the chart, where it does not work so well, where the word we use is whipsaw, where we're kind of whipsawed back and forth with losing trades while the market is not trending. Moving averages, when they're used to identify trends, will work well when the market is trending, but the problem, of course, as we've already discussed in the course, is that markets do not always trend. So this is why it's very important that you understand the statistics behind whatever tool you're using. And you're going to, when you start doing research, reading, talking to people about technical analysis, you're going to hear a lot of things. And some of these things are true. Some of the things might not be true, because a lot of what passes for traditional technical analysis has not really been tested. It's just been handed down from gurus or writers in the past. And a lot of this work was done when people did not really have access to data, when price charts came from newspapers, when there was no computing power. So many of the things that people think about and talk about with technical analysis actually predates, I like to say sometimes, that it predates the data age or the data analysis age. And today we can test ideas very simply, very easily. This is a chart from a very famous paper by Brock, Lakonishok, and LeBaron, published in 1992, in which they looked at technical signals. They looked at crossovers of different periods of moving averages. And this is an equity curve that I constructed when I wrote one of my books. I looked at their research and reconstructed their research, and they found that many of these trading signals work quite well. And this does appear to work quite well. If you just look at the equity curve, this is assuming that you invested $100,000 in each trade back to the 1920s, and pretty much whatever was going on in the world, wars, recessions, booms, your equity curve goes up. This appears to be a very robust system. But the problem is, this is the point where they published their paper. If we move forward, this is what the equity curve looks like for the next couple decades. The thing is flat to losing money. So we always want to make sure that we look at the statistics and we understand what is actually going on in terms of a statistical edge. Back to the idea of looking at the moving average slope as an indicator of trend. That's what I'm showing you here. So this takes a large sample of stocks. You can find more about it in one of my books. A large sample of stocks, futures, and currencies, and then some randomly generated price data, and says, okay, what happens if we take all of the days in which the moving average slopes down? That's the first section of this chart. And what we find is that the excess return in stocks is 167 basis points. That's 1.6% positive. And here, go down to the next box here. If you took only the days in which the moving average sloped up, the average return is 158 basis points negative. So in stocks, if you're trading with the slope of a 50-period moving average, this is a 50-period simple moving average, you are already statistically on the wrong side of the market. Yet this is a very common tool that many traders use, and they probably have never looked at the statistics like this. But you can do this. You can do this relatively easily. You also see some evidence that futures might trade differently than stocks. So your moving average sloping down gives you a positive average return. In stocks, in futures, it gives you negative. So there is some evidence there may be some difference between asset classes. And this really just scratches the surface. Whatever tool you use, whatever system you use, it's definitely worth spending some time to investigate the stats so you know what edge might or might not be there. Quick summary here. So we looked at what a moving average is, a moving running average, ways to use them, why we use them, because they filter out noise, can show us trends. We looked at different types of moving averages, ways to use different combinations of moving average, and we looked at some ways in which they're commonly used in technical analysis, price touching, crossing a moving average, different periods of moving average responding differently to price, and then looking at crossings of moving averages. That is all I have for you in this unit. I'll see you back for the next. Thank you very much.